everyone, this is Allan coming to you from the Oscar Tortola group. Today we're going to be talking about down payments and private mortgage insurance. That's why I'm joined today by Ryan. Now, for those of you who aren't familiar with Ryan, he's one of our preferred lenders. He's been working with us for a couple of years. Go ahead and introduce yourself a little bit, Ryan.
Hi, my name is Ryan Cairney. I work with Easy Fundings. Our corporate office is based in Rancho Cucamonga, California. And I've been in real estate for a little over 3 years now, and now I'm helping the OTG group with their lending needs.
Post his information below if you want to reach out to him with any loan questions or if you want to get pre-approved or pre-qualified. Ryan's your guy. So now when it comes to down payments, there's a big misconception that you need 20% down or should have 20% down. Is that the case, Ryan?
No, it is not.
Okay. Now, there are a couple of different loan programs, right?
Correct. We've got FHA, VA, and conventional options.
All right, so those are the three most common?
Those are the three most common we deal with.
All right, so let's go ahead and start with FHA. When it comes to FHA, how much do you need to put down?
FHA, they have to come in with 3.5% down. That's across the board all the time. And there's mortgage insurance on that, which is on it for the life of the loan.
Mortgage insurance, all right. So for those people who aren't too familiar with that, what is mortgage insurance?
The mortgage insurance is going to be on there anytime you put down less than 20% on a property.
Okay, so is that, how long does that last? Do you have to keep paying that?
FHA, it's on there forever. So the only way to get rid of it is to refinance out of it.
Refinance out of it, and you'd be refinancing into a different type of loan?
Into a conventional loan, ideally.
Okay. Now, when it comes to conventional loans, what's the down payment required for that?
Down payment, we have one program that you come in with as little as 1% down, but the other options are anywhere from 3% down all the way up to 20%. And any of the options with less than the 20% down, you're gonna have mortgage insurance on it, which is gonna be based off your credit score and how much money you're putting down.
Okay, so how much you're gonna be paying every month in mortgage insurance is based on your credit score?
Correct.
And the loan amount?
No, the down payment amount.
Down
so the
payment
more,
amount.
more money you put down and the higher your credit score is, the lower that percentage of mortgage insurance is gonna be.
Oh, okay, got it. Now, when it comes to how long that lasts?
That's on there until you get enough equity in the property, which in Riverside County, a lot of properties are shooting up real quick after people purchase them, so they're able to get rid of the mortgage insurance a lot quicker than they anticipated.
Okay, so that you can, with rising equity or with rising home prices, you can actually get rid of it sooner before having to pay the loan down.
Correct.
Okay, cool. Now, when it comes to VA loans, how much is required?
VA is 0% down.
0%.
Yes.
So no $0.
$0.
No money up front.
No money whatsoever.
Okay. Now the VA loan is a program offered for veterans. So obviously you have to be a veteran to qualify for it.
Correct.
How does that work?
0% down as long as that property is under 453,100, which is the conforming limit out in Riverside County. Anything above that, they have to come in with 25% of the difference of that amount.
Okay, so let's say I bought a home for $553, right? That's $100,000 over the
limit. They would be coming in with $25,000 as opposed to the $100,000.
Oh wow. Okay, so for you people who didn't follow that, I'll go ahead and write it down so you can follow the numbers a little bit more easily. Okay, so you said there's a loan limit for VA.
Correct.
Right.
It follows the conforming loan limit of conventional, which is 453,100 out in Riverside.
Okay, so loan limits for conventional is 453.
Correct.
For VA is 453.
Yes.
And for what about for FHA?
FHA is going to be 405,950, which is going to put the purchase price right around 420ish.
Okay. So why would somebody go, because the loan limit's lower, why would somebody go FHA instead of conventional?
FHA, the interest rates are typically better because the interest rates for FHA aren't based on your credit score, whereas conventional, they're going to go off your credit score, so the lower your credit, the higher the interest rate's going to be.
Okay, so definitely depends on a person's credit score, their situation.
The biggest issue is going to be their credit score.
Okay, but typically, no matter what your credit score is, there should be some type of loan program, right?
It can get trickier, but we can always get it done.
Okay, and at the very least, as long as you speak to Ryan, he can go ahead and give you some advice, put you on the right path, so that way you can purchase a home in the future within a couple of months. I mean, we've had clients, right?
Yes, we've had plenty of people who've helped fix their credit to get their scores up where they need to purchase.
There you go. If you do have any questions, you can go ahead and leave those in the comment below. You can reach out to anyone on the Oscar Tortola group, or you can reach out to Ryan directly. Ryan's very informative. He's helped many of our clients. I'm always calling him, asking him questions because
That he is.
Because I'm not in the loans. I'm more focused on real estate. negotiating that side of it. So if you have any questions, go ahead and reach out to us, leave it in the comments below. Stay tuned for next week's video, and as always, the Oscar Tortola Group is
Your smart choice in real estate.
Thank you, Ryan.